Thank you, Greg. Many years ago when I used to work for a company that I now refer to as Beyond Patience, we used to have facilitated two-day management workshops where we'd go away and discuss strategy. And the facilitator, who I'm sure we made into a millionaire, we used him so much, had an interesting technique, which is on the first day he would get you really, really depressed. He would tell you all sorts of stories, and people would come in from head office who had all sorts of stories, and the company was going down the tubes and so on and so forth. And then on the next day, you'd have the uplifting, particularly from the CEO, uplifting moments, and you'd leave in this fantastic mood, and everything would be fine until you got on the M25. And then you would think, well, life really is quite complicated. So before the coffee break, we may have the two depressing, less than optimistic talks this morning. I want to, some of you will have heard that, let me see if I can get this working, yeah? Thank you, Gary. Some of you will have heard that DEC, Department of Energy and Climate Change, commissioned Sir Ian Wood, who's the founder and relatively recently retired chairman of Wood Group, to undertake a review about how we maximise recovery in the UKCS, economic recovery. And he produced an interim report back in early November. It then went into a consultation process, and that's been going on, and apparently they will produce their final report in the next month or so. He had essentially three recommendations calling on three different bodies to do something, because he was recognising fundamental starting point was there's a heck of a lot of potential left in the UKCS for exploration, for development of as yet undeveloped discoveries, to shift, I mean, it goes to Greg's question, shift typical recovery factors from around about 38 or 40% to 60 plus, etc. Lots of potential, and this will all go sailing past us in the night and not be realised unless we do something fairly soon. So that was his kind of message. The potential is there, we need to move fairly urgently. And you probably maybe saw that the other day, beginning of this week, this was backed up by the head of Oil and Gas UK, Malcolm Webb, who Oil and Gas UK, which as you know is the industry body that represents oil and gas companies and service companies, said this is urgent, it is not something that we can leave for a while, we need to change things. And then he stretched credibility slightly by urging rapid action by Her Majesty's government, but we won't go there. But these were the three actions, really three groups that Sir Ian Wood's team addressed, and that was backed up by Oil and Gas UK. So HM Treasury should continue to find a way of incentivising future development, future recovery, changing tax, changing the fiscal regime. And then that, based on the model of the NPD in Norway, which is very active in managing the oil and gas sector in Norway, DEC should create a new arm's length regulatory body. Just as a matter of interest, the NPD employs about 200, 250 people, all of them petrotechnical staff. So interesting question as to where they're going to come from in our industry. But that this regulatory body should have additional powers and capacities, and one of the things it should do, several things it's recommended to do, but to develop and implement strategies. So not just write things down, but actually be in charge of the execution of strategies to do with regions, so west of Shetland, southern North Sea, central North Sea, northern North Sea, and so on in the UKCS, exploration as a whole, and technology, the application of technology, technology development, and so on. So that was, DEC should do this, and then industry must commit to, you know, one of the big beefs that came through the initial consultation that 3 and Wood's group did was that little companies are throttled by big ones who own infrastructure and won't cooperate and charge unreasonable prices and generally say or do unreasonable things. And that somehow all these characters who are operating in southern North Sea and regions need to be forced to cooperate. Asked to cooperate in the first instant, but with the expectation of relatively little success, forced to cooperate by the regulatory body in the way that the MPD actually basically does in Norway. So an interesting set of please change the fiscal regime. We want this new regulatory body with all these powers, and if you guys don't behave better, we'll hit you. Kind of message. You know, my issue with this is that doesn't sound like so. On the one hand, you have 3 and Wood and Malcolm Webb from Oil and Gas UK saying this is urgent, this needs to happen quickly, and I don't see up there things that are going to happen quickly. I mean, if, for example, you want to create something like the NPD in Norway with 250 people, that's not going to happen 2014, 2015. It's going to take a long time just to get there. And personally, as a geoscientist, I would have extreme hesitation about being a civil servant, but that's a completely different issue. And I actually think, if you read the report, you can go online to Wood Review, alloneword.co.uk, and read it for yourself. The initial review is about 15 pages, and it doesn't really mention costs at all in any shape or form. I mean, it reads like a let's do things better document from one of the major political parties. I'm sorry if this doesn't, the words in the red box don't show up too well, but what I'm actually suggesting is that, and we got into that a little bit in in Ozzy's talk and the previous, and the discussion of it, and I'm probably ditching my remote remaining chance of getting a knighthood by saying these things, but I disagree with what this group came up with, in the sense that I believe costs are the major issue in the North Sea, not just in the UKCS, but the Norwegian sector as well. And these costs have been essentially exponentiating. Escalating is another word. It sort of suggests slightly less pace, but they've been exponentiating over the last 3, 4, 5 years. And the result of that alone, is that new projects, whether these are in-field developments to go to improve recoveries, drill more wells in a big way, or discoveries that have already been made, what you're seeing is that these projects are being cancelled or delayed. And that is without talking about decommissioning costs, which are typically in any discussion of value in the North Sea, a little bit the elephant in the room that people forget to mention, that this late life field has got decommissioning costs, which are a legally binding cost, appearing over the horizon in 2021 or 25 or something like that. So when you take all those things together, projects are being cancelled, delayed, and infrastructure is going to be disappearing in front of our eyes. And there was a study done about 3 or 4 years ago by I think somebody from the SPE, who produced a series of maps looking at infrastructure in the North Sea and the Norwegian Sea in 2015 and 2020 and 2025. And it was just a picture of shrinkage, because there's no new infrastructure and no renewal or work on the existing base. What evidence is there for that? Well, you actually only need to just read the industry magazines, newspapers, and so on over the last 3 months. And companies are And actually one or two of these are really quite startling, but companies are delaying or cancelling projects. So last week, Statoil announced that the development of Kristin, which is obviously in Norway, was terminated. This is about 1.5, 2 TCF, and you know it is the project economics are fundamentally unsustainable because of the cost base. I think Oz mentioned, or Greg mentioned, Rosebank, West of Shetland, Chevron. Again, about a month ago, they said they doubted doubted as a company whether this was developable, and they gave a rather long quote. Does not currently offer an economic value proposition that justifies proceeding with an investment of this magnitude. And in brackets, you could read them saying, and we have far better, if we're going to invest $5 or $6 billion, we've got far better places to put it. Angola, Gulf of Mexico, etc. So this is going on. Statoil, slightly different wording. Statoil Bressay is a heavy oil development. It's sort of one of the middle range of heavy oils. It's not the most heavy oil. But they said, okay, we've looked at the costs. We're reevaluating. This will be delayed. We need to think about alternative development options and so on. And, you know, companies are not doing this in private at executive committees. They're saying these things and publishing press releases. And then I've mentioned the NPD already, a Norwegian regulatory body that looks after things there and from time to time makes public pronouncements. They, again, earlier this year, I mean, not middle of last year, this is all from the last 2 or 3 months, said, okay, here's a list of projects that are all going to be delayed because of costs and lack of infrastructure. Statoil, common feature in these, but just as an example, Johan Sverdrup is 1.2 billion barrels. And they're saying, you know, we can't develop this. The costs are too high, you know. And ultimately, if you dig into it, what they're saying is we can't afford to drill the wells that you need to drill to develop this field, because particularly the costs of rigs have gone up so much we just can't do it. And, you know, Oz was hinting at this, the Barents Sea looks like a new frontier opening up, but the MPD's view is that pretty much all of the projects in the Barents Sea are in danger of delay and so on. And actually they said gas discoveries in the Barents Sea will not be developed in the foreseeable future. So these, you know, and there's gas prices are an element of that, lack of infrastructure is an element of that, but costs are driving these discussions. So it's kind of, you know, everything is negative and costs are the heart of the issue. Now, if you, you know, my previous employer, who I've mentioned once already, sort of lived and died a little bit by this cartoon, which says that what happens in a basin, and we all know this, is that you get the big discoveries, actually big simple discoveries first. As you go on, the discoveries get smaller and more complex. And, you know, over some life cycle of a basin, whether it's 20, 25 years, you get all the big resources discovered up front, and later things are getting smaller. And what happens is that translates into a value curve where you deliver lots and lots of value early on, but ultimately you're overtaken by costs hitting smaller, deeper, more complex, nastier petroleum discoveries, and ultimately you get to a point where these curves, the value curve, the cumulative value, the value curve, and the cost curve cross, and you start getting into value destruction in the basin or the region. And this drives companies to go, we're off. We're going to Angola, Brazil, Nile Delta, you know, you name it, but to leave. And that's a kind of strategic picture in a way. There has to be more to it than that, and I thought a place to start would be to start looking at some of these recent projects, both in the North Sea and around the world, and say, well, what can we actually say about their economics? And these are just some examples. And there's a little sidebar comment about the difficulties of collecting consistent, useful data. But these are all down to here are all North Sea projects, and this one's from Ghana and this one's from Angola. The ones in black are producing already. The ones in red are kind of not approved or delays have been announced. And these two, which are Mariner and Kraken, which are both heavy oil fields in the North Sea, are announced as they're going to proceed. So strictly, I suppose, under development, or very early stages of development. One of the things you discover when you start, and my sources for these are public data, so things like companies' capital markets days, what's on companies' websites, and so on. And the thing you discover very quickly is that if you look at the description of any project on a company's website, there's a lot on there that you should take with a pinch of salt. I mean, just as when I had to make presentations to the executive management about the glories of a new field development in Angola, I would play with the economic model a little bit. You find that there are a couple of levers that make parameters such as NPV or real rate of return look quite optimistic. One of them is always shortening the time between discovery and first oil, which has a magic effect on NPV. And the other is switching costs from capital to operating. So typically with FPSOs, you can see instead of taking the cost of capital expenditure, company is leasing it back from SBM or whoever is providing it in the first place. And those make huge changes in economic models. So when you start digging into projects and saying what is on a company's website, what you can't do is believe numbers like NPV and rate of return. And particularly you can't just compare them because they're all different. So the only thing I concluded that you could safely do is look at the actual cost that is discussed, look at the reserves in millions of barrels. These are usually the same sort of number, some sort of P50, and look at the target, or what some people call the nameplate production. So, this thing that we're doing, what production rate are we promising when it gets on plateau? So these are, as I say, all these fields. This is the cost in billions of dollars. This is reserves in millions of barrels. And this is nameplate production in thousands of barrels of oil equivalent per day. So just to be clear, something like Clare Ridge cost around $7 million. It's producing actually just short of 640 million barrels. And when it's on plateau, a year after it started up, 18 months ago, it's producing 120,000 barrels a day. So that's what these numbers are. Problem with these is you look at them and you think, well, I can't see any pattern at all, really. Some of these costs are big, some of them are smaller. Some of these numbers are big, some of them are smaller. Some of these numbers are big, some of them are smaller. But, so it's a little difficult to make a coherent sense of the numbers. But if you do this with them, so this is a cross plot of up along the horizontal axis, dollars per BOE of reserves, and this point here is $25 a barrel. So to the left, less than 25, to the right, more than 25. This is how much you're paying for that nameplate production in dollars per barrel of oil per day. More than $100,000, less than $100,000. And so this point is 100 on that axis. And that actually is a very simple cartoon, but what you can say is this, that frontier projects in basins such as those offshore West Africa and Brazil, where you've got 300 million barrels or more of reserves, 150,000 barrels a day of production, they all sit in here. So Jubilee in Ghana, the Angola, PVSM in Angola and so on, sit in here. You have all of the smaller, more complex, deeper, nasty petroleum / heavy oil and so on projects in the North Sea sitting here. So these are the ones that go ahead without question. These are the ones that are now being delayed. And then you get some in here which have quite significant volumes, but still cost challenges. So something, I didn't choose these numbers accidentally, and you can argue that therefore the picture is a bit of a contrivance, but the Clare Ridge sits exactly here on that cross. So Clare Ridge is producing just over 100,000 barrels a day, and at about $25 a barrel, and I think it's $99,000 per BOE per day. So something like Clare, which is big, plenty of production rate, and operated by a single company, or operator group, BP and Chevron basically, flies perfectly well. And they have had fantastic, if you know anything about the history of Clare and Clare Ridge, this is a sort of fractured basement, for want of a better word, field, 8 billion barrels in place, fantastic need to apply technology to get the thing to work at all. So its two driving features are an operator group that can drive down costs and technology to get the thing moving and drive down costs as well. So that sits in here. Interestingly, just as Greg was making the point about looking into our industry and other industries, about our ability to get projects done on time, on budget, and at the production rate we promised. The Angola project I mentioned started here. It would be bang in the middle of this green block. It was 2 years late and overran by 40%. And that moved it into exactly this sort of point. So, there's another side issue that this is all about what we promise, having stripped out the economic model and just looking at costs and reserves and production. There's another issue of delivery, that when we actually have a project that we like and is economically viable, we have a reputation as an industry for delivering things late and over budget and not quite achieving production profile. And the Angola project is a classic example of that. So more complex stuff in here than I've talked about. But so what do I conclude from this? As I say, simple, bigger projects, single operating group, including something like the Clare Ridge. More complex, smaller, more difficult petroleum, actually smaller companies and so on, and that will not proceed in the current climate. And other projects in here which are cost challenged but can move. What I conclude from that is this. I think everybody who comments agrees that the situation is critical and urgent, and trying to be uncynical about the speed at which governments respond. This is not something that governments can respond to quickly enough. I mean, if you allow things to get through a normal cycle and we go through another election, it will be too late. We will be living out the disappearance of the infrastructure. My personal view is this is strongly important. You can look at the contribution of technology to enabling fields to be developed with less wells, to more thoroughly monitor where fluids are being produced, how they're being produced, where they're not being produced, and detecting where there are untapped resources. I think the more controversial point is this is not going to move unless there's a period of industry consolidation. You cannot proceed quickly if we have a lot of small companies, for example in the southern North Sea or the central North Sea, all doing their own thing, all competing with one another, all complaining about the infrastructure owners not cooperating and so on, and somehow expecting a regulatory body eventually appointed by the government to sort this out. The industry has to sort this out. And I think the lesson is that you can get things to move if you have enough reserves of discoveries and in-field reserves amenable to enhanced oil recovery, several 100 million barrels under the control of single operator groups. And this requires a period of consolidation. And with that, I'm going to stop and put my final slide up maybe. This isn't just an issue for the North Sea, this is an issue for Northwest Europe. It is an urgent problem, and we cannot sit and wait for the government to solve this problem for us. The industry has to solve it itself. With that, Greg, over to you.
Okay. Rather provocative, thank you. That's what we like. We need to get some change. Some of us have been involved with this attempt at consolidation. I think maybe, I don't know if you missed this or not, but in the mid-90s we consolidated a number of smaller fields to create the ETAP project. And I remember the project team worked on that for several years before they managed to persuade all of the companies to go ahead and develop together. And it took a hell of a lot of commercial effort. Consolidating companies is also, as I'm finding out myself right now, quite challenging. And usually what stops me is the bloody lawyers and accountants are charging me several £100,000 to put together, say, two maybe $10 million companies or something like that. So costs are everywhere here. And I don't see that that's going to change all that quickly. I don't know anybody here volunteer to take a big pay cut, but that's part of the reason why costs are high. So, what's your view on that? How do we go about addressing the more fundamental? What's the driver of cost? Aside from, yes, we can consolidate. Yes, we can do more technology, but there's no driver of it at this stage.
No, I mean, one thing that is clear is that, I sometimes put my tongue in my cheek and say, well, a body like Oil and Gas UK, which complains a lot, consists of a couple of hundred companies. Only 40 of them are oil and gas companies, the other 150 oil contractors. So why don't contractors just put their prices down? That would work, wouldn't it? In a competitive market. But just as oil and gas companies can clear off to Brazil, Angola, or Southeast Asia, so can contractors. So if you've got a drilling rig, you can say, well, I can get $650,000 a day in Ghana for it, and I have no need to deploy it in the West of Shetlands, particularly if you're offering me, you want to offer me half of that. So, we actually live in a global market. And I don't see, I think the answer is for prices to drop, oil prices to drop. And I think we're at a stage where $50 a barrel wouldn't do us any harm, is my personal view. Certainly wouldn't do me any harm because my company would continue paying my pension. Hamish.
The question really on the market, is it the market that determines, David? You were accused, along with Attila here, of killing off the seismic industry, because when the boot was on the oil company's foot, you could really drive down prices. And now the boot isn't. The service companies are putting prices up. And is that not an oil company's cost, is a service company's revenue? Is that not just the market that's doing that?
Yeah, you can see the market changing, actually. If you look, you're absolutely right. And you know, I can remember going with Keith Nunn, with somebody's leaving party at Western Geco about 15 years ago, maybe 10 years ago. And Andrew Gould at the time was the CEO of Schlumberger. He stood up and said, Keith Nunn, David Bamford and Ian Jack are the guys who murdered the seismic business. And a few years later, of course, the opposite was true, in that seismic companies were charging much higher prices. If you look at the forward forecasts of the main seismic contractors made in the fourth quarter of last year, they're all saying hard times are back. You know, the order books are down 20%. And fundamentally, I think that's because oil companies are beginning to think twice about exploring. And, you know, there are a couple of Oz and a couple of people I've talked about this. This is because investors are saying to companies, investing in exploration is possibly the worst idea you've had for several years. You know, they weren't saying that 2 or 3 years ago, but now they are. So, you know, I think the market is swinging, but it's clearly not swinging for example, deep water rigs. You know, I mean, you can still, as I know too well, spend $200 million drilling a well in French Guiana using a fourth generation rig, and that's a lot of money.
Any other questions?
Hi there, Dave. Can I put you on the spot? How much did a square kilometre of seismic data cost you 10 years ago or 15 years ago?
Well, it depends how we bought it. But if it was multi-client, then, I don't know, Keith, $3,000 a square kilometre? Something like that? As a multi-client.
Yeah, but how about as a proprietary project?
I don't know, 10 maybe? 10, 15, yeah.
Yeah, you see, I really don't accept that. Our seismic business has actually made the vessels very much more expensive to operate, but they've actually kept the prices of seismic down very closely. And if you're saying, well, maybe 10 years ago we were only paying 3,000 for spec data, and today you're not really paying much more than double that, that's not bad going over 10 years when you consider the amount of investment the seismic industry has made. Seismic is still a very, very cheap multiplier for your exploration and development efforts in comparison with many other activities.
No, I absolutely agree. I think all I'm saying is that explorers are beginning to feel the heat from investors, and the next in line to feel that are seismic contracting companies.
Could also, one of the other things that wasn't very clear is that you talked a lot about costs increasing in Northwest Europe. To what extent is that intrinsic? Because you said it's harder, more difficult areas that we're looking at, and so therefore some fourth generation rig that can operate in a high pressure, high temperature environment is not exactly the same as some three-legged monster from the Gulf of Mexico from 20, 25 years ago or whatever. So that's intrinsically going to be more expensive. But to what extent do you think it's to do with the regulatory environment pushing up costs, and also things like decommissioning, which is, you know, we're getting to a situation where you've got to clear away and leave the seabed as if you'd never been there. Yeah. And when you build the M25, you don't say, well, build in the cost to turn it back into farmland afterwards.
Yeah, I think it's a good question, because if you look at what the Wood Review was recommending, which is we have a regulatory body like the NPD, and you look at what, Greg touched on it earlier, what the Cullen Review was still pushing towards, which is stronger regulation based on safety cases and so on, both of which exist quite strongly in Norway. I mean, there's no doubt that those have driven up costs. You're absolutely right. Whereas, you know, even in Brazil, where you have a reasonably strong local entities, that's not occurred. But then the volumes are so much bigger that you can perhaps bear the costs. But it's a complicated problem, I admit, and you know, I have simplified it a lot. But crudely. But I'm not convinced that a new regulator is the right answer in getting things done and getting costs down, which is, I think, the point you're getting.
Time for one more question.
Yeah, hi.
Philip Kladek, Bloomberg Research. I have one question regarding the consolidation that you mentioned, that companies need to just get bigger. Wasn't it also said, I heard this before, that small companies are better suited to exploit mature basins because they have a more slim cost base, they have less fixed cost, just their cost structure is leaner, and that's why they can live economically off a smaller field with a lower production volume? How does this fit together with the consolidation?
I mean, to me, I, for example, I know the Gulf of Mexico quite well, and it's very clear that the Gulf of Mexico shelf and a lot of the onshore is driven by smaller companies, hundreds of them, thousands of them. And they obviously manage to work very effectively and relative to us somehow relative to Europe at low cost. So there's an anomaly there that I can't resolve. This is a good question. The theory, based on observation of the Gulf of Mexico shelf, would be that there comes a stage where you hand the basin over almost to independents, and they make it work, and continue to make it work. But in our world, somehow for some reason, that doesn't happen. I don't know why. No.
Part of the reason is because it costs $40 million or 40 million pounds to drill a well here.
Yeah,
It costs
compared with.
$5 million there. Anyway, I think we don't have time for any more questions, but thank you to David for